There's a story behind this that's worth telling. While economists debated whether the largest generational wealth transfer in history would happen in 2030, 2040, or maybe 2050, it was already moving. Not in headlines, not in press releases from financial institutions eager to manage those trillions, but in probate courts, in revised trust documents, in family meetings where uncomfortable truths were finally spoken out loud. The numbers they fed you were always designed to keep you waiting. $68 trillion transferring from boomers to younger generations over the next 2 decades. That's the figure you've seen repeated everywhere, like some distant promise that keeps getting pushed further into the future. But here's what they don't mention when they cite those projections. The transfer isn't scheduled like a rocket launch. It's not waiting for some predetermined moment. It's happening right now, every single day. And the people who understand this are positioning themselves while everyone else watches the countdown clock to an event that's already underway. I started noticing the pattern in 2019 before anyone was talking about pandemic-related mortality or the economic disruptions that followed. Estate attorneys I knew were suddenly working 80-hour weeks, not because of some new tax law creating a deadline rush, because the volume had fundamentally changed. The parents of boomers, the silent generation who accumulated wealth through the post-war boom, were reaching the actuarial cliff. Life expectancy tables are remarkably accurate at scale, and that cohort was hitting the age where wealth doesn't just sit in portfolios anymore. It moves. Then 2020 accelerated everything in ways the projections never anticipated. The models economists built to predict this transfer were based on historical mortality rates, on predictable patterns of aging, on the assumption that life expectancy would continue its slow upward march. Those models didn't account for a pandemic that disproportionately affected older populations. They didn't account for the stress-related health impacts that would follow. And they certainly didn't account for what happens when millions of people simultaneously confront their own mortality and start making decisions they had been postponing for years. Here's the crucial part. Wealth transfer isn't just about death, though that's the mechanism that forces the final movement of assets. It's about the decisions that precede it, the gifting strategies that accelerate when someone realizes their timeline is shorter than they thought, the trust modifications that happen when family dynamics shift, the early inheritances given to children struggling with housing costs that have detached completely from wage growth. Look at the real estate market right now, and you'll see the transfer already embedded in the data. First-time homebuyers in major metro areas with median purchase prices exceeding $600,000. The math doesn't work on salary alone, not even for professionals in high-income fields. Software engineers in Seattle, attorneys in Boston, marketing executives in Austin. Their incomes are substantial by historical standards, but they're still showing up to closings with down payments that represent 3, 4, sometimes 5 years of gross salary. Where's that money coming from? The mortgage industry knows exactly where it's coming from, even if they don't advertise it. They've created an entire category for it in their internal analytics. Family-assisted purchases. No, that's the sanitized term for what's actually happening. Parents selling investments, liquidating portions of their retirement accounts, taking equity out of their own homes to help their children access a housing market that has fundamentally broken free from wage-based affordability. This isn't the wealth transfer of financial planning brochures, where elderly parents peacefully distribute assets according to carefully constructed estate plans after long, fulfilling lives. This is the messy, urgent, real-time version where people in their 50s and 60s are watching their 30-something children get permanently locked out of wealth-building opportunities, unless they intervene now, and intervene they are. The IRS data tells you the scope if you know where to look. The annual gift tax exclusion gets adjusted for inflation, but the number of people utilizing it has increased by margins that far exceed population growth or demographic shifts. In 2019, approximately 2.6 million gift tax returns were filed. By 2022, that number had climbed past 3.1 million. That's not a gradual increase. That's a behavioral shift happening in compressed time. But even those numbers vastly understate what's actually occurring, because most of the transfer is happening below the reporting threshold. Parents can gift the annual exclusion amount, currently $18,000 per recipient, without any filing requirement. For a married couple with 2 children, that's $72,000 a year moving intergenerationally with complete invisibility to any official tracking system. Multiply that across millions of families, and you start to understand why the wealth transfer isn't some future event. It's the background radiation of the current economy. What's remarkable about this is the people receiving this wealth don't feel wealthy. That's the psychological paradox that makes this transfer fundamentally different from previous generational handoffs. When boomers inherited from their parents, they were typically inheriting supplemental wealth, assets that enhanced their already established financial positions. They'd already bought homes, built careers, accumulated their own savings. The inheritance was extra. For millennials and Gen Z, The wealth transfer isn't supplemental, it's foundational. It's the difference between participating in asset ownership or being permanently relegated to renter class, between starting a business or remaining an employee, between having children or postponing that decision indefinitely due to economic uncertainty. This fundamentally alters the psychological relationship to inherited wealth. There's no sense of windfall, no feeling of getting ahead. There's just the sense of barely keeping pace with the previous generation's starting position, and only then with their active financial assistance. The banking sector understands this dynamic perfectly, which is why their marketing has shifted so dramatically in the past 5 years. Look at how private wealth management firms now advertise their services. It's no longer focused exclusively on the elderly client preserving wealth for eventual distribution. Now it's multi-generational planning, family legacy conversations, strategies for efficient wealth activation across age cohorts. That's corporate speak for, we know the money's moving now and we want to capture it at every transition point. Here's where it gets more complex, because the wealth transfer isn't distributed evenly, and that inequality has profound implications that nobody wants to address directly. The $68 trillion figure represents aggregate wealth movement, but the distribution is more concentrated than any previous generational transfer in American history. The top 10% of boomers hold approximately 70% of boomer wealth. Read that again. This is crucial to understand. Like when people discuss the great wealth transfer, there's an implicit assumption of broad-based intergenerational improvement. Millions of younger people receiving inheritances, getting help with down payments, benefiting from parental wealth accumulated over decades. And that is happening, but it's happening overwhelmingly within families that were already wealthy. For the bottom 50% of boomers, there's essentially nothing to transfer. Negative net worth or near zero estates consumed by end-of-life medical costs are the reality for tens of millions of families. The wealth transfer, as a phenomenon that actually impacts life trajectories, is occurring almost exclusively in the upper middle class and above. This creates a divergence that's accelerating with each passing year. Young people with access to family wealth are snapping up assets, homes, investment properties, business equity, all the vehicles that generate further wealth. Young people without that access are falling further behind in relative terms, regardless of their own income or effort. You can see this in the data on first-generation wealth builders versus those from wealthy families. The gap isn't just persisting, it's expanding. And it's expanding precisely because we're in the midst of this transfer, not despite it. The real estate market is the most visible manifestation, but it's happening across every asset class. Private equity positions, angel investments in startups, cryptocurrency accumulation during market downturns. These are the purchases that establish generational wealth. And they're increasingly dependent on having capital available at the right moment, capital that comes from family wealth rather than personal earnings. This reveals something important. The wealth transfer is actually increasing inequality within generations, not just between them. Millennials are becoming the most economically divided generation in modern American history, not because of differences in education or work ethic, but because of inherited access to capital. The media narrative around generational wealth obsesses over boomers versus millennials, as if those categories were economically coherent. They're not. The relevant divide isn't generational, it's whether you're connected to family wealth networks or you're not. If you are, you're experiencing what feels like a difficult but manageable economic environment, one where housing is expensive and student debt is burdensome, but ultimately navigable with family support. If you're not, you're experiencing an economy where fundamental wealth building has become structurally inaccessible, regardless of your individual decisions. And here's what makes this particularly insidious. The people benefiting from family wealth transfers generally don't recognize it as the determining factor in their outcomes. There's a well-documented psychological phenomenon where people attribute their successes to personal merit and their advantages to background factors they discount as minor or incidental. So you get 35-year-old homeowners who genuinely believe they achieved that position through careful budgeting and career focus, conveniently forgetting or minimizing the $40,000 down payment gift or the year of rent-free living with parents while saving or the family connection that led to their first job. This isn't about individual moral failing, it's about how human psychology processes advantage. But it has real consequences because it shapes political and policy preferences. People who successfully navigate the economy with invisible family wealth support tend to oppose policies that would redistribute wealth or provide public alternatives to family-based support systems. They genuinely believe the system rewards merit because it rewarded them, not recognizing that they were playing a different game with different rules than someone without family wealth access. Meanwhile, the transfer continues, accelerating in ways that won't appear in official statistics for years. Remember this point. Wealth transfer shows up in IRS data after it's completed, after estates are settled, and gift tax returns are filed. There's a multi-year lag between the actual movement of wealth and its appearance in the data sets economists use to make projections. So when they tell you the big transfer is coming in the 2030s, they're working from data that's already 3, 4, 5 years old, data that predates the acceleration we've seen since 2020. The real-time indicators tell a different story. Luxury goods sales among younger demographics. Investment property purchases by buyers under 40. Business formation with substantial initial capitalization. These are all running at levels that far exceed what you'd expect based on wage data alone. The venture capital world has noticed. There's been a significant increase in founders from wealthy backgrounds, not because wealthy families suddenly started producing more entrepreneurial children, but because starting a company increasingly requires the ability to go without salary for extended periods to cover initial costs, to maintain personal solvency through the inevitable early struggles. That's only realistic if you have family wealth backing you. The mythology of the garage startup launched with credit cards and pure determination is increasingly just that, mythology. The successful founders still exist, but they're disproportionately the ones who could afford to take the risk because failure wouldn't mean personal financial destruction. The same dynamic is playing out across every field where success requires upfront investment or unpaid apprenticeship. Arts and entertainment, politics, nonprofit leadership. These sectors were never particularly accessible to working-class participants, but the barrier has grown substantially higher as the wealth transfer provides some young people with the financial runway to spend years building careers that don't immediately generate income. The result is institutional leadership increasingly drawn from a smaller and smaller economic segment of society, even as those institutions claim to value diversity and broad representation. Here's the crucial part. This isn't sustainable, and the people managing the wealth transfer know it. I've sat in enough wealth management conferences to hear what they say when they think nobody's recording. There's deep concern about the social stability implications of what they're facilitating. Not moral concern, understand? Practical concern about whether the system can maintain legitimacy when wealth concentration reaches certain levels. They study history. They know what happens when economic mobility becomes fictional, when entire classes of people realize that effort and merit are disconnected from outcomes. The wealth management industry is simultaneously profiting from the transfer and genuinely worried about the long-term environment they're creating. Their solution, such as it is, involves philanthropy and impact investing, ways for wealthy families to feel like they're addressing inequality while maintaining the fundamental structures that create it. It's the same pattern you see throughout history when wealth concentration reaches unstable levels. The very wealthy fund schools and hospitals and arts programs, genuinely helpful things that nonetheless don't threaten the underlying distribution of economic power. One thing that really stands out to me. And the transfer continues, largely invisible in daily life, but fundamentally reshaping who has opportunity and who doesn't. Tax policy is the other arena where you can see this playing out. Estate tax exemption levels have been raised to the point where they're effectively voluntary for all but the wealthiest families. Currently, you can transfer over $12 million as an individual, over $24 million as a couple, before owing any estate tax at all. That wasn't an accident. That was the result of sustained lobbying by families who wanted to ensure their wealth could transfer with minimal government intervention. And it worked. The estate tax, which once affected a meaningful percentage of estates, now applies to only about 1 in 1,000 deaths. For the truly wealthy, the ones transferring hundreds of millions or billions, there are sophisticated trust structures and valuation techniques that minimize even those tax obligations. The result is that the wealth transfer is happening with historically minimal revenue generation for public purposes. Previous generations saw more of inherited wealth flow through taxation into public investment. Infrastructure, education, research, the things that created broad-based opportunity and economic mobility. This transfer is different. It's more efficiently staying within family networks, which means it's more efficiently perpetuating advantage across generations. What's remarkable about this is it's happening during a period when public investment has collapsed to historic lows as a percentage of GDP. We're simultaneously experiencing the largest private wealth transfer in history and the smallest public investment in generations. Those two facts are related. The families benefiting from the wealth transfer have strong incentives to oppose taxation that would redirect some of that wealth to public purposes, and they have increasing political power to block such policies. The result is a self-reinforcing cycle where private wealth concentration enables political influence that protects wealth concentration. You can see this in state and local politics, where property tax limitations and exemptions have proliferated. These policies are often marketed as helping ordinary homeowners, but their primary effect is protecting the wealthy from taxation on their most significant assets. In California, you have homes worth millions paying property taxes based on assessments from the 1970s because of Prop 13. That's inherited wealth protection masquerading as taxpayer relief, and it's replicated in various forms across most states, always with the same story. we're protecting homeowners from being taxed out of their houses. The reality is, you're protecting inherited real estate wealth from contributing to the public revenue that would help people who did not inherit property. This reveals something important. The wealth transfer isn't just an economic phenomenon. It's a political one, actively shaping policy in ways that ensure its continuation and minimize its contribution to broader social benefit. The financial media covers none of this with any depth. You'll see occasional features on the coming wealth transfer, always framed as future tense, always focused on the opportunities for financial services firms to capture those assets under management. You won't see analysis of how it's currently reshaping opportunity structures. You won't see investigation into the policy changes that have enabled it to transfer so efficiently within families. That's not an oversight. That's editorial choice, driven by who owns media companies and who advertises in them. The same class benefiting from the transfer controls the narrative about it. Here's what this means moving forward. The economy you're experiencing is increasingly dependent on whether you have access to family wealth, and that dependency is going to intensify, not diminish. If current patterns continue, and there's no particular reason to think they won't, we're heading toward an economy where asset ownership is functionally hereditary. Not legally, but practically. The mechanisms of market access, the capital requirements for participation, the timeline to accumulate down payments or investment stakes, all of it is diverging from what's achievable through wages alone. This has profound implications for how you should think about your own financial planning and career decisions. If you have access to family wealth, your optimal strategy is different than if you don't. And I mean legitimately different, not just easier. If you can access capital for down payments or business formation, you should be optimizing for equity and ownership rather than current income. Taking strategic risks that have high potential payoffs becomes rational when failure doesn't mean destitution. If you don't have family wealth access, you need to be more conservative and more strategic simultaneously. More conservative because you can't afford mistakes that would be recoverable for someone with family backing. More strategic because you need to find the narrow paths to asset accumulation that don't require substantial upfront capital. That might mean geographic arbitrage, moving to lower cost areas where wages decline less than asset prices. It might mean house hacking, buying a multi-unit property and living in one unit while renting others. It might mean business models that are capital efficient, service businesses, or online operations with minimal startup costs. The paths exist, but they're narrower and more difficult than they were for previous generations. And they're getting narrower each year as the wealth transfer continues to concentrate asset ownership among those connected to family wealth. The other option, the one that doesn't get discussed much in personal finance content, is political. If the system is rigged, and it increasingly is, one response is to change the system rather than trying to optimize your position within it. That means supporting policies that redistribute wealth, that increase taxation on inherited assets, that provide public alternatives to family-based support structures, universal down payment assistance, public banking options, aggressive estate taxation above certain thresholds. These policies face enormous political obstacles precisely because the people who would be affected negatively have disproportionate political power. But that doesn't make them less necessary. It makes them more urgent. The wealth transfer that is happening right now is creating a society where your starting position determines your ultimate position more than any time since the Gilded Age. Individual effort and merit still matter at the margins, but they matter less than they used to, and they matter less with each passing year. You can adapt to that reality on an individual level, making the smartest possible decisions within the constraints you face. But collectively, the question is whether we accept this as the permanent condition or whether we decide that it's not the kind of economy we want to leave to the next generation. Because here's the thing, they don't tell you in the wealth management brochures. The generation receiving this transfer will eventually transfer it to their children. And it will be even more concentrated, even more determinative of life outcomes, even more disconnected from any notion of earned success. This isn't the end of the story. This is the beginning of a new phase where wealth is increasingly dynastic, where the mythology of American social mobility becomes harder to maintain even as fiction. That future isn't inevitable, but it's the trajectory we're on, and the wealth transfer happening right now is what's driving it. The question is whether enough people recognize what's happening in time to demand something different. Because the transfer isn't coming, it already started, and unless something changes, it's going to reshape everything about how our economy functions and who it functions for. The choice about what happens next isn't really about money. It's about what kind of society we're building, and whether we're building it intentionally or just letting it emerge from the accumulated decisions of people protecting their own family wealth. That's the story behind the numbers. That's what's actually happening while everyone watches projections about the future. And that's what you need to understand to make sense of the economy you're actually living in.